Welcome to the deep dive, where we take stacks of information, really, and pull out the most important nuggets of knowledge or insight. We give you that shortcut to being truly well informed. Today, we've got a fascinating mix, really a collection of sources spanning everything from the latest box office hits to the, complex world of tariffs and the, frankly, accelerating pace of AI.
That's right. Our mission today is to cut through the noise. We'll connect the dots on some big market shifts, unpack what's defining wealth right now, which is interesting, and explore how technology isn't just changing industries. It's changing our daily lives, even our physical well-being.
Okay, so let's unpack all of this. Get ready for some, I think, surprising facts and maybe a few aha moments along the way. All right, first up, let's kick off with a look at the broader economy. Stocks, well, they ended the week lower. All three major averages, the Dow, S&P 500, NASDAQ Composite, all down, despite some earlier highs. And a big driver behind this seems to be something making headlines again.
Yeah.
Tariffs.
Yes, exactly. This week, President Trump announced a pretty significant 35% tariff on Canadian imports. The stated reason was fentanyl. And he's also threatened even higher duties if Canada retaliates. Plus, he's talked about blanket tariffs, maybe 15% to 20% on other partners. That's quite a jump from the current 10%.
So what does this all mean, like practically for markets, for everyday business?
Well, it's interesting. There's this phenomenon some analysts are starting to call tariff fatigue. It seems to be weighing on markets. While, stocks initially seemed to sort of melt up and volatility, the VIX actually went lower, Barclays is cautioning that the full impact on growth and inflation, well, we haven't really seen that yet.
So kind of a mixed signal there.
Exactly. It suggests this complex picture where, yes, tariffs might give a short-term fiscal boost, but those long-term ripple effects on growth, on inflation, they remain unpredictable. Crucial factor for markets, though. And we're already seeing tangible real-world effects. Some Walmart garment orders from Bangladesh, for instance, they've been put on hold because of this 35% tariff threat.
And that's significant for Bangladesh, right?
Huge. Their garment sector is like 80% of their export earnings. So factory owners there, they anticipate orders will just fall. They simply can't absorb that 35% rate. Though, it's worth noting, some manufacturers had already absorbed part of an earlier 10% tariff back in April. And interestingly, Levi's, the jeans maker, seems to have managed some of the impact by holding about 60% of its inventory for the rest of the year.
Okay, but here's a twist, though. The US dollar actually got stronger this week against major peers. One trader suggested it shows a belief the US is, quote, winning the trade war. And tariffs seem to be helping government finances, too.
That's another really fascinating development. It's a stark contrast many aren't seeing, maybe. The Treasury Department reported an unexpected surplus in June, $27 billion. This followed a $316 billion deficit in May. Customs duties, largely from these tariffs, they surged to about $27 billion just for the month. That's a staggering 301% gain from June last year. So yeah, significantly helping offset the growing federal debt, at least in the short term.
Speaking of government finances, let's pivot slightly to this friction between the White House and the Federal Reserve. OMB Director Russell Vought is demanding answers from Fed Chair Jerome Powell. It's over the Fed's headquarters renovation project. He's calling it an ostentatious overhaul, costs running up to maybe $2.5 billion.
Right, and Vought's allegations are quite specific. Plans for rooftop terrace gardens, VIP dining rooms, premium marble. He suggests the project is out of compliance with the National Capital Planning Act. However, Powell, under oath to Congress, strongly denied these claims. He said, quote, no VIP dining rooms, no new marble, no special elevators, no new water features, no beehives, and no roof terrace gardens. Calls the media reports misleading and inaccurate.
Okay, so regardless of the details of the renovation spat itself, this is happening while President Trump keeps pushing the Fed to cut interest rates, right? Down from the current, 4.24% to 4.5%, down to around 1%.
Exactly. And this really brings that critical discussion about the independence of the Federal Reserve right to the forefront. A Fed chair can only be fired for cause. Things like inefficiency, neglect of duty, or malfeasance in office. Now, Powell's term as chair doesn't expire until May 2026. But this new line of criticism from the administration, backed by newly appointed board members to that planning commission, well, it could be seen as an attempt to build a for-cause case.
Interesting angle.
Meanwhile, you have the president's big, beautiful bill, which is projected to add another $3.4 trillion to the national debt over the next decade, and current interest payments on the $36 trillion national debt. projected at $1.2 trillion for the full fiscal year.
Wow. Okay, let's build on that and look at another huge force reshaping things, artificial intelligence, AI. A
Yeah.
financial expert from Franklin Templeton recently predicted that companies that, quote, get AI right are going to take off, and we're seeing some really groundbreaking steps happening.
Yeah, this is where it gets really interesting, I think. Goldman Sachs, top investment bank, they're piloting Devon. It's an autonomous software engineer created by an AI startup called Cognition. This program, Devon, is expected to soon join Goldman's, get this, 12,000 human developers. Cognition claims Devon is the world's first AI software engineer, and that startup is now valued at nearly $4 billion.
Okay, so Devon isn't just like a smart chatbot helping out with code snippets. This is agentic AI, meaning it can actually take initiative and complete complex projects on its own.
Precisely. Agentic AI, like Devon, it can execute complex multi-step jobs, things like building entire applications, not just assisting with small tasks. Goldman's tech chief, Marco Argenti, he anticipates hundreds, maybe thousands, of Devons will initially handle the sort of drudgery jobs like updating internal code. He envisions this hybrid workforce where humans and AI work side by side. And the projection, boosting worker productivity by maybe 3 to 4 times.
That sounds incredibly efficient. But okay, the big question, what does this mean for you, for people's careers? What's the impact on jobs when AI can do the work of multiple engineers?
It's a critical concern, absolutely. Bloomberg's research arm predicts banks alone could cut maybe 200,000 jobs in the next 3 to 5 years just due to AI implementation. However, Argenti's vision isn't solely about replacement. He emphasizes that human engineers will need to evolve. Their role becomes describing problems, supervising these AI agents.
So a shift in skills.
Exactly. It's not about humans becoming obsolete necessarily, but adapting to this new role of oversight, strategic direction. The insight really is the nature of work, even in highly technical fields, is shifting, moving from pure execution towards managing AI.
Okay. And beyond the corporate offices, AI's impact is reaching like fundamental parts of our infrastructure too. President Trump is heading to an energy and innovation summit in Pennsylvania next week, and AI is a core topic there.
Indeed. The CEO of the American Petroleum Institute, Mike Summers, he argues that for the U.S. to win the AI fight, it needs energy dominance. He points out energy demand is expected to jump by 25% in the next 7 years. Compare that to only 2.5% annually in recent years. It's a huge increase. And Pennsylvania is key here. It's the second largest natural gas producer in the U.S. Amazon just announced a $20 billion investment in data centers in the state.
So does this AI energy surge contribute to rising costs in places like Pennsylvania, even as people might be looking there for affordability? That connects back to what we'll talk about later with cost of living, right?
Absolutely, it's a direct link. The need for massive energy consumption by these AI data centers, it will undoubtedly put pressure on local grids, and yes, potentially impact the regional cost of living. It creates this fascinating interplay between tech advancement and, economic accessibility. And this AI boom is clearly reflected in market movements too. Look at NVIDIA. CEO Jensen Huang recently sold about $36.4 million in company stock, yet NVIDIA keeps hitting milestones.
Yeah.
It just became the first company to top a $4 trillion market cap this week.
And here's a truly surprising fact I saw. Huang's net worth, now $143 billion, is basically neck and neck with Warren Buffett. That just highlights the explosive wealth being created here.
It really does. For investors looking to maybe capitalize on this, some pros are using options, trading high-flying tech stocks like NVIDIA, trying to capture upside while limiting risk. Another interesting play we're tracking is Tom Lee's Granny Shots ETF. It's quickly become one of the most popular successful active stock funds this year, outperforming its benchmark significantly since launching last November.
Okay, so practically, what's the upshot for you, the listener? Can AI actually assist us with our own complex financial decisions? Things like Medicare, Social Security, long-term care. Or is that still too much for the tech?
Yeah, those are definitely high-stakes, complicated choices. While the full scope of AI's role in personal financial advice is still, developing, this whole discussion highlights the potential. Technology could aid in these complex decisions, even if it might not fully replace the human element, the human advisor. The insight here is probably to be aware of how these AI tools are emerging. They could potentially become invaluable assistants to your human advisors, offering new levels of data analysis, scenario planning for your long-term financial health.
All right, let's transition now to a topic that, well, it touches everyone. Personal finances. And what does it even mean to be wealthy in America today? A recent Charles Schwab Modern Wealth Survey had some really eye-opening findings.
It certainly did. Surprisingly, the average net worth Americans feel is needed to qualify as wealthy actually declined, down to $2.3 million from $2.5 million last year. And that's largely attributed to people feeling there's a worsening economy.
Mhm.
Yet the amount needed just to be financially comfortable, that increased year over year, up to $839,000.
Huh. What stands out to you in those numbers? That contrast is interesting.
Well, the generational differences are pretty striking. Baby boomers, for instance, they set the highest bar for wealthy $2.8 million. Gen Z, much lower, $1.7 million. But despite these shifting thresholds, 63% surveyed feel it just takes more money to be wealthy today. Main reasons: inflation and the economy. Interestingly, though, Gen Z and millennials are the most optimistic about actually achieving wealth. And that optimism seems linked to actively saving, investing, having a financial plan. Ultimately, when people define wealth, happiness at 45% and funds at 44% are basically tied as the biggest factors.
So the definition itself is evolving?
Seems like it. It highlights this shift where maybe comfort is gaining ground on extreme affluence. For you, the listener, this might mean recalibrating your own financial goals. Focusing on a robust plan rather than just chasing a super high number might be the real path to, perceived prosperity and peace of mind.
That's a great perspective. Okay, now let's literally look at the cost of living across the U.S. We've got data on America's cheapest and most expensive states for 2025.
Right. West Virginia holds the title, least expensive state to live in. Its imposite cost of living index is less than half that of Hawaii, which is among the most expensive. And just to put that in perspective, eggs in Kalamazoo, Michigan, they're about 20% cheaper than in Newark, New Jersey. A head of lettuce in Manhattan, Kansas is 15% cheaper than in Manhattan, New York. Little examples, but they highlight the disparity.
But beyond just groceries, what are the big cost drivers making some states so much pricier?
Housing and homeowners insurance. They're huge factors. California, for example, most extensive state overall, nearly 40% of households there pay over a third of their income just on housing. In San Jose, average home price, $1.86 million.
Wow.
And Florida, another highly expensive state, is grappling with the nation's worst homeowners insurance crisis. Average annual premiums there are $15,460, largely due to more frequent, more severe storms.
And this high cost of living, especially somewhere like New York, it's actually driving migration, you mentioned. How significant is that? What's the motivation?
Oh, it's very significant. We're seeing this trend where wealthy New Yorkers are actively looking at Florida real estate. There was a 50% spike in website traffic to South Florida agents right after a recent primary election involving a far-left candidate. This candidate proposed policies like citywide rent freezes. Between 2018 and 2022, over 125,000 New Yorkers moved to Florida. They brought nearly $14 billion in adjusted gross income with them, and this could fuel a second wave, potentially. The motivation seems clear. Tax advantages, sure, but also seeking greater stability, safety, and what they perceive as an elevated quality of life.
So the insight for listeners is...
It's that the search for economic comfort, it often involves this holistic assessment. It's not just income, it's expenses, taxes, even that perceived quality of life in different places. Geography matters.
Okay, let's also touch on retirement savings. For Gen Z and millennials, the average millennial saver contributes about 7% of their salary. Often auto-escalating, investing in target date funds, it's kind of seen as a set-it-and-forget-it approach.
Right, and while that sounds convenient, the real question is whether set it and forget it is truly enough in today's economy. Or is it leaving significant opportunity on the table for actually boosting that nest egg? The insight might be that passive saving, while definitely a start, may not be sufficient for more ambitious goals. Understanding your investment choices, maybe actively managing your plan, could potentially unlock substantial additional growth.
Okay, this next point connects to long-term well-being in a way people might not immediately think about. The rising issue of falls among older adults. Seems unrelated, but it has huge financial and personal implications.
It absolutely does. Death rates from falls for adults aged 65 to 84 have surged over 70% in just the last 2 decades. Over 40,000 older adults died from falls in 2023 alone. It's a serious public health issue. Projected treatment costs for fall injuries expected to exceed $101 billion by 2030.
So prevention is critical here.
Absolutely key. Simple home modifications, removing throw rugs, ensuring good lighting, installing grab bars can make a huge difference. Regular eyesight, hearing checks are crucial. Strength and balance exercises like yoga or Tai Chi can really help. And technology is playing a role too. Systems like Sensi.ai can monitor changes in gait, even potential mental decline. So for you, the listener, it means thinking proactively. preparing legal documents like a living will, healthcare proxy, even being aware of proposed legislation like the Stand Strong Falls Prevention Act, which aims to pilot Medicare coverage for home safety modifications. The real insight here is that personal well-being directly impacts your long-term financial stability. Proactive steps in health and home safety are just as crucial as any investment strategy.
That's a powerful connection. Okay, finally on personal finances, let's talk about a surprising tax twist from President Trump's big, beautiful bill.
Yes, this is what some tax experts are calling a SALT torpedo. While the bill increases the state and local tax, or not, deduction limit to $40,000 for 2025, there's a catch. There's a phase-out for modified adjusted gross incomes, MAGI, between $500,000 and $600,000. For individuals in that specific bracket, the reduction of the deduction can lead to an artificially high federal tax rate of 45.5% on those earnings within the phase-out range.
So how does that translate for someone potentially in that range?
It means if your income might hit that threshold, it's absolutely critical to run projections with the tax advisor and consider strategies to maybe reduce your MAGI if possible. The takeaway for you is that tax planning isn't just about maximizing deductions anymore. It's also about anticipating and mitigating these potential high tax traps that can pop up from new legislation.
Good point. And just a quick note on credit. Buy now, pay later loan data will soon be accounted for in FICO scores. One expert warns that could, quote, churn credit catastrophe. So just another evolution in financial metrics to watch. Okay, let's shift gears. Let's look at some other notable movements across industries, starting with a big win in entertainment. Exciting news for fans of a certain Man of Steel.
Yeah, Warner Bros. New Superman film generated $22.5 million just in Thursday night previews. That's the best preview number for any Superman film ever. And third best for a DC superhero flick under the new DC banner. Projections are for it to take in somewhere between $130 million and $140 million during its full 3-day opening weekend.
Wow, impressive numbers. That's a super start, you could say. And this isn't just good for DC fans, but for the whole movie theater industry, right?
Absolutely. This is the first big theatrical project under James Gunn and Peter Safran's new 10-year DC plan. Critics seem to be on board too. It's holding an 83% fresh rating on Rotten Tomatoes. And yes, it's definitely good news for the exhibition industry overall. AMC's stock is rallying after an upgrade, partly citing an improving box office. It suggests that, despite all the talk about streaming, the big screen experience still has a powerful draw, especially for these major blockbusters.
Okay, moving to big tech and social media, Amazon's Prime Day was expanded to 4 days this year, but early data suggests shoppers might actually be spending less. One marketing outfit saw a 41% sales decline on day one compared to last year. What does that tell us about consumer behavior right now?
Well, it could indicate a couple of things. Maybe that tariff fatigue and inflation we talked about are making shoppers more cautious. Or perhaps the longer duration of Prime Day just diluted that sense of urgency. The insight, perhaps, is that even with these major sales events, consumers seem to be becoming more discerning with their discretionary spending, which reflects those broader economic pressures we've been discussing.
Makes sense. And for TikTok, its future in the U.S. still uncertain, but we're seeing some interesting developments there, too.
We are. A New Hampshire court rejected TikTok's bid to dismiss a lawsuit. This suit alleges its addictive design features exploit children, focusing on the design rather than just the content itself. President Trump has already granted 3 extensions for ByteDance to sell off its U.S. operations. The latest deadline is now September 17th. There's even talk of very wealthy people being ready to buy the app, and reports suggest TikTok is building a new standalone app specifically for U.S. users. It really highlights the immense value placed on user data and the platform itself, even amidst all these significant regulatory and legal pressures.
Okay, before we wrap up, let's connect a few other market highlights. Sometimes understanding market sentiment comes from unexpected places, like collectibles. You're tracking the Labubu toy craze.
Yes, this is fascinating. Beyond traditional markets, even the surging popularity of collectibles like these Labubu toys, it offers this curious window into consumer discretionary spending. And the hunt for alternative assets, especially among younger demographics, it's kind of a barometer of where disposable income is flowing. On the more traditional side, we've seen silver surge. The Global X Silver Miners ETF hit a multi-year high. That reflects renewed interest in precious metals amid all the economic uncertainty. In corporate news, Kraft Heinz is reportedly weighing a breakup after a decade together, citing struggles with inflation-fatigued shoppers and that ongoing shift towards healthier diets. That tells us even established food giants are really grappling with changing consumer tastes and the persistent squeeze of inflation. And lastly, A proposed blue sky partnership between United Airlines and JetBlue is facing scrutiny from a U.S. senator. The fear is it could harm competition, lead to fewer, more expensive options for consumers, especially in the New York City area. Underscores how regulators stay vigilant about consolidation impacting consumers.
Wow. Okay, so from Superman's soaring box office to the, intricate dance of tariffs, those incredible leaps in AI, and the very personal questions of wealth and well-being, it's really been a deep dive into a week packed with information.
It has. And the common thread, I think, running through all of this is certainly that dynamic interplay between global forces, technological innovation, and, well, our individual experiences. What seems clear is that understanding these diverse fields is more interconnected than ever. It creates both challenges and, frankly, opportunities for all of us.
So what does this all mean for you? As AI continues to reshape industries, reshape career paths, and as those traditional benchmarks of wealth seem to be evolving, how might you need to reevaluate your own financial planning, your long-term goals? Maybe consider the potential for both disruption and, importantly, new opportunities in this rapidly changing economic and technological landscape we've discussed today.